This strategy uses one candle to find profitable trades every single day. No complicated indicators, just one candle and 3 simple rules. The best part is that it works on stocks, cryptocurrencies, and even forex pairs. It's called one candle scalping, and by the end of this video, you'll have the complete system you can start using today. Most traders are stacking indicators on top of indicators, trying to filter out the noise of the charts with more noise. And the more they add, the more ways they give themselves to second guess a setup, more ways to talk themselves out of a good trade or to even hold on to a bad trade. That's not the right approach. This strategy doesn't do any of that. The entire system runs off one candle, specifically the 4-hour candle that forms during the day. That candle's high and low is what forms your range for the whole session. Everything we do on the 5-minute chart is built around it. It's called the 4-hour range. And once you understand that, the rest is pretty simple. So let me show you how to set it up. So step 1, mark the high and the low of the first 4-hour candle of the day. Here's exactly how to do it. Open your charts and set the time frame to 4 hours. Then you need to go to the time zone setting in the bottom right corner and switch it to New York time. That part is super important. This strategy is anchored specifically to the New York time. Now find the first 4-hour candle that formed on today's date, and you need to draw a line at the high and draw a line at the low and extend both lines to the end of the day. That's your range. Something people get wrong here is they mark the range while the candle is still forming. You need to wait for it to fully close. If you mark it early, you're going off incomplete data and the whole thing falls apart. Wait for the close, then draw your lines. That's step 1 done. Now we drop down to the 5-minute chart, and this is where the trade comes together. What we're looking for is a 5-minute candle to close outside the range, either above the high or below the low, and the rule is that wicks don't count. The candle body has to fully close outside. A wick that spikes through and snaps back is not a valid breakout. Full close or it doesn't count. After that breakout, we wait. We need a 5-minute candle to then close back inside the range. So the system is breakout, then re-entry, both within the same trading day. That's the setup. If price breaks out and never comes back in, there's no trade. The re-entry basically works as our confirmation. So once you see a confirmed setup, the entry is completely rule-based. So if price broke above the range high and re-entered, you go short. If price broke below the range low and then re-entered, then you go long. The breakout tells you the direction the market tried to go, and the re-entry tells you that it failed. So you're basically trading the failure or the reversal. Now, your stop loss is an extremely important part of this trading system. Your stop loss goes at the exact extreme of the breakout move. The highest high if you're shorting, or the lowest low if you're going long. The take profit is 2 times the stop loss size. That's 2R every single trade. But let's say the breakout was massive. If that happens and the stop loss ends up being huge, don't use the exact extreme. You need to find the nearest key level instead. It keeps the risk manageable. 3 steps, completely mechanical. Let me show you what this looks like in real trades. By the way, the platform I'm using throughout this video will be linked down below. The cool thing with Exness is they allow you to start an account with just $10. So you can check it out down below if you're interested. Now let's look at some live recordings, some of my live recordings of trades I took over the past few weeks. First things first, every morning I mark the 4-hour range. That's the high and the low of the very first 4-hour candle that formed that day, based on the New York time, of course. Those 2 levels become my entire game plan for that day. No indicators cluttering the chart, no guessing, just the range. So my first trade was on gold. I'm watching the 5-minute chart. So as we can see, price starts pushing down toward the range low and breaks below it. And here's the key. The candle actually closes below, not just a wick, a full close. The wicks don't count, of course. Then the next candle closes back inside the range. That's the sequence. Breakout, come back in. That's my long signal. The range low just acted as a trap. Price dipped under, grabbed liquidity from the people who were holding shorts, and then came back inside. It's a classic move, but before I touch the buy button, I check the MACD. In this case, it happens to be positive, so momentum is pointing up, which lines up perfectly with the long trade. Both the setup and the momentum are telling me the same thing. That's confluence, and confluence equal confidence. Entry goes on that candle close back inside the range. Stop loss is at the exact low of the breakout move, because if price goes back down there, the trade thesis is dead and I'm out. No arguments. My take profit always remains at 2R, twice the risk. That's the target every single time. So as you can see, price nudges up, starts to look like it's working, and then the market just said no. No fake out candle, no warning shot. It just rolled over and came back down through the range low. Broke the stop, and that was a $1,200 loss. Even though I followed all my rules, the market just didn't care. Now at this point during the day, I was about ready to quit because I had waited for that setup for about 60 minutes, but then I took a second trade, same day, different market, Euro USD, 4-hour range is marked, and I'm back on the 5-minute chart watching price move inside the range. Then it starts climbing, price pushes above the range high, and again the candle close outside, full body above the line. I've seen this before. Price breaks above the range high, which triggers all the retail buy orders that have been sitting above it, breakout traders jumping in late, stop losses being hit on shorts. The market grabs all of that liquidity and then reverses. It's a stop hunt, and the candle closes back inside the range is the confirmation that the breakout failed. Next candle closes back inside, that's a short signal. Now I go to the MACD, which is negative. Momentum is already pointing down. The setup is saying short, the momentum is saying short. When everything is aligned like that, there's nothing to deliberate about. You take the trade. Entry on the close, stop loss goes at the high of the breakout candle, the very top of that failed move, because if price goes back up there and crosses, the whole setup is invalid and I'm out. Take profit at 2 hours as always, same process. Price drops immediately, no hesitation, no fake out. The kind of move where you set the trade and lean back because there's nothing left to do. It works its way down and cleanly hits the target. Now this was my biggest trade for the year and nearly $9,000 winner. The morning started the same way it always does. I marked the 4-hour range on Bitcoin, high and the low of the first 4-hour candle that formed that day, New York time, fully closed before I put a single line on the chart. I've done this so many times at this point, it's automatic. So then I drop down to the 5-minute chart and I start watching. Bitcoin was trading inside the range, just moving around, nothing was happening as yet, and then it started to push toward the range high. I watched it climb, touch the level, push above it, and the candle close outside. Anyone can see a candle break a level. What matters is what happens next. The next candle started forming and I watched it carefully. It opened above the range high and then price started pulling back and then it closed back inside the range. Right there, that's my signal. But before I do anything else, I need to check the MACD, and the MACD was negative. When the MACD is negative, that means that the signal line is above the MACD line. This orange line you can see right here above the blue line. That means it's negative. That means the trend is a downtrend. So momentum was already pointing down even as price was trying to push higher. That right there was the divergence between what price was attempting to do and where momentum actually was. The setup was saying short, the momentum was saying short, so I go short. I put my entry on the close of this candle inside the range right here. Stop loss went at the high of the breakout candle, the very top of this failed move, because if Bitcoin went back up there, then I was wrong and I need to get out immediately. My take profit was set at 2R. That means it's twice the risk. Same target it's always been. Then Bitcoin dropped. Strong red candles, barely any pullback, each one closing lower than the last. I was watching it move and remember thinking, just let it run, don't touch it. You've done everything right up until this point. So it hit the 2R target and I closed the trade. And I sat there for a second and I was just looking at the number on the screen. $22,187 from one trade on a Friday morning. I didn't add to it, I didn't move the target, I didn't do anything clever. I just followed the same rules I always follow and the market paid. That was my biggest trade of the year. And the reason I'm bringing that up isn't a brag, is because of something I think about a lot when it comes to trading and risk. And I must remind you guys, these results aren't typical and trading involves serious risk. This is a replay of some live trades I took earlier this week. Now here's the part where most people messed up. They see the break and they jump in immediately. Don't do that. We don't care about the break on its own. What we need to see is the candle actually close outside the range. The wicks don't count, and then we need price to come back inside. That's the setup. And right here you can see the candle closes back above the range low. That's our signal to go long. Entry right here on that close. Stop loss goes at the lowest point of the breakout move, because if price goes back down there, the setup is dead and we're out. No arguments. Take profit is always set at 2R, meaning twice whatever our stop loss is, and then we just let it cook. So as we can see, price started to climb and it hit the target. Done. Clean trade. That trade right there was $915 in the green. That's a nice trade. Alright, so this is the second trade I took for the day. Same range, still active. Price has been moving around inside after the first trade and now it's starting to push up toward the range high. Let's see what happens. It breaks right above the range high. Candle closes outside. Okay, we're watching, and then the next candle closes back inside the range. That's it. That's our short signal. We flip it. Instead of going up, we're looking now for price to come down. Entry on that close back inside. Stop loss goes at the high of that breakout, because again, if price goes back up there, we're out, we're wrong, we are done. We want our trade to stop, and the take profit always remains at 2R. Price dips a little, bounces slightly, and I'll be honest, for a second it looked like like it might go against us. That's normal, that's trading, but then it rolls over and heads straight down to the target. That one closed. It was a $794 trade, 2 trades, both green, so I'm done for the day. I know what some of you are thinking, that looks too simple, and yeah, it kind of is, but simple is not the same as easy. The hard part is trusting the rules when price is moving and your brain is telling you to do something else. Most traders lose money not because their strategy is bad, but because they don't actually follow it. This system is only one range, 3 simple steps to our target. It only works if you actually stick to it. Every time you go off the script, you're basically trading a different strategy. Now, this was the absolute basic version of this strategy. No extra filters, no confluence with trend direction or structure, no additional confirmation at all. Just the 3-step checklist exactly as it is. You can now combine this with concepts you already use like support and resistance, trend direction and volume, and you'd notice the performance goes up from here. This basic version already works. The more refined version is even better. But my recommendation is you don't take my sample and call it proven. Run this for yourself, get at least 50 trades on a market that you know well before you put real capital on it. See what the numbers look like in your hands. But the thing is, this strategy is completely rule-based, so the results should be replicable. But as I said, you need your own data. However, a good strategy is not the only thing you need when trading. As a matter of fact, it's only 40% of what you need. The other 60% boils down to your psychology. So check this video out next to help with that.